Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So there is currently an illness spreading around the world, the word for which I cannot say on this video without being demonetized. So you already know what it is. We also had a 30% massive drop in oil last week. And that sort of 1-2 punch, as Warren Buffett put it, in the stock market is causing some incredibly volatile prices. We've had days where the stock market has gone down 7 or 8% across an entire index, not just one individual company. And we've had days where the stock market's gone up like 9% in a day, which is just insane volatility. There's a lot of craziness going on out there at the moment. And I've got a lot of messages from you guys over on my Instagram. Go follow me there at Investing with Tom if you don't already. Basically just asking for my thoughts on this whole situation. So let's get into that. I'll explain kind of what I'm doing personally, the way I view the whole situation, and then I'd love to hear your thoughts on what you're doing as well. So certainly drop any comments or questions also down in the comment section below. But for now, let's get into it. So as of today, when I'm filming this video, the stock market is down, depending on what index you look at, anywhere from about 15 to 20%. So there's a few different countries that I kind of follow the indices for, Australia, New Zealand, and the US being the big ones. And again, depending on which one you look at, we're down anywhere from 15 to 20%. So it's all happened very quickly. That has created a couple of different types of investors out there. So we first have the type of investor that is currently very nervous, and we secondly have the type of investor which I personally fall into this second camp, which is getting very excited and kind of going on a quite aggressive sort of bargain hunt out there in the stock market. So in terms of my strategy through this sort of little crash that has been going on, basically my fundamental strategy is unchanged. At the end of the day, I'm looking to identify businesses that I understand, that are in my circle of competence, that have some sort of competitive advantage, have great management, and that most importantly, I can buy at a price well below their intrinsic value. So as a result of declining prices, we are typically going to have more companies trading below their intrinsic value, and that's been something that has been quite difficult to find over the last few years, but we're going to likely get more and more opportunities if this thing continues to go down. So that's very exciting for an investor like myself. But there's certainly some things to kind of watch out for, and some things that I'm monitoring with the businesses that I'm looking at. The first big thing that I've done during this recent decline is something that I put up a brief community post about last week. I'm basically saying that I was going through and sort of refreshing my watch list. So if you don't know already, I have sort of a watch list of stocks that are well within my circle of competence, have a good moat, have great management, but don't often meet the fourth and final criteria, which is available at a discount to intrinsic value. So essentially what I did last week is I went through all of those companies on the watch list. Many of them I was already pretty up to date with on the business itself, because they're businesses that I follow regularly. But most of them I do not have an investment in because it hadn't met that fourth criteria of margin of safety, discount to intrinsic value. So I essentially went through last week, made sure I was fully up to date on what was going on with the businesses, and most importantly did a valuation across all of those stocks to see where their current prices sit relative to where I think intrinsic value is. So getting really up to date with what I think they're worth, what I would personally buy those stocks at, what price I would purchase them at, and getting kind of a game plan in place. It's something that I already largely had sitting there ready to go. It's just a matter of kind of updating that list. So that would be the first thing that I recommend you all do as well, is have a plan going into this. Identify businesses that you really like, and identify businesses that you would be comfortable putting some money into if they got to the right price. So I'm not going to give you any of the companies or anything that I'm looking at, but that is fundamentally my strategy. Now, there's a couple of things that I'm also keeping an eye on when I'm doing these valuations in these businesses. So as an investor, I think it's very easy to take what the business is currently doing, what it's done in the past, and kind of extrapolate that out to infinity. So that is something that we really have to avoid doing where possible. So in order to value a business, we have to make some estimate of what we think that company is likely to earn in the future. And if we go into a major recession, those earnings are going to be compromised. It is going to change our intrinsic value estimates. So we have to really understand how these businesses that we're looking at may or may not be impacted by what's going on in the world currently. So if you take the example of an airline business, for example, airlines are not a sector that I have done a huge amount of research on at all. But fundamentally, we know that the air travel sector is going to have quite a rough at least next quarter or two by the looks of things. So people are cancelling their travel plans left and right. They're booking less and less trips out into the future, and that can only be bad news for travel companies. And in terms of airliners that you might be looking into, there's a couple of key things to follow. So the first thing would be basically, can this business, number one, can it survive? A lot of companies with interest rates that have been so low over the last several years have massive amounts of debt, and that's something that you're going to have to keep a really close eye on. So if an airline business that you're following and interested in investing in is going to have a dramatic change in cash flows where they flip into the red, flip into the negative, how long can they sustain that before they basically end up bankrupt? That is going to be quite a fundamental question as to whether or not you make that investment. Now, the good thing with airline businesses is they've also had something move very strongly in their favor, which is a decrease in oil prices. So fuel costs for an airline business have a dramatic effect on profitability. So if we have the virus that shall not be named, causing disruptions in travel, we at least have a positive in terms of a decreased cost to provide services because of that change in oil price. So there's a few different moving pieces kind of going on there, but fundamentally, you've got to make a conservative estimate of your intrinsic value, figure out where you think that business might be a couple of years from now, and then start looking at out into the future beyond that to kind of calculate your intrinsic values. Buy it with a big margin of safety. We're not trying to pick up something worth $100 for $99. We're trying to get big discounts, buy those $100 bills for $50 and those sorts of things. So that's the first thing I'm doing. The other thing I'm doing is I'm buying stocks. So there are a few companies on my watch list that are now at margin of safety prices. There are a few stocks that I already owned that have got even cheaper, some of which I already had the position sort of built out, and I'm not that comfortable adding to further to make an even larger percentage of my portfolio. As much as I love concentrated investing, I'm not going to push that boat out too far. But I'm basically keeping an eye on my watch list companies, adding to positions and buying where those opportunities do come up and where I think I'm getting a really good deal. And I'm continuing to follow things day to day on the sort of personal finance side, continuing to save as aggressively as humanly possible so that I've got cash ready to go for these opportunities when they do come up. And that is fundamentally my strategy going through what is going on out there at the moment. So there's two final things that I want to talk about as it relates to what's currently going on in the stock market. And the first one is quite a big mistake, in my opinion at least, that I see a lot of people making. So that is basically assuming that if a stock is down 20, 30, 40%, that means it must be worth, you must be getting it at a discount of 20 or 30 or 40%. Just because the stock price has come down, that means you must be getting a good deal. And that is probably one of the largest mistakes you can possibly make in investing. Just because Tesla stock, not to pick on Tesla, but just as a major example, just because Tesla was trading at $900 a share and it's now down to maybe $550 a share or something like that, it doesn't mean that Tesla had an intrinsic value of $900 a share and you're now getting a substantial discount. It's still going to have to produce enormous cash flows to be fundamentally worth $550, which it very may well do, and it may very well do enough cash flows to be worth $900 today or more. We will have to wait and see. But you've got, just because the stock traded there does not mean it was fundamentally worth that amount. That's the key message that I want to get across. You've got to make a judgment call on how much cash you think that business will produce over a period of time. And if it's not going to produce enough cash to justify a valuation, a conservative valuation at that, it doesn't mean it's cheap just because it was trading for less than it has previously traded for. You know, if things are very, very overvalued just because they come down in price, doesn't mean they are now suddenly undervalued. Markets are not efficient as much as a lot of people like to say that. They're not efficient. Stocks are very volatile. Just by the very nature of the auction-driven markets that they survive in, and it means that prices can fluctuate very, very widely, and just because it traded at a high price at one point doesn't mean it was actually worth that. And on the other kind of side of the coin, just because it trades at a really, really low price doesn't mean it's fundamentally not worth a whole lot more than that. So that's the first sort of big mistake and big mindset change that I'd like people to take from this video. The second one is I see a lot of people out there trying to time the market. And I'm not a huge fan of market timing at the best of times. I think when opportunities arise, you should jump on them. I personally am looking at individual companies. So when individual companies are going through troubles or are undervalued for whatever reason, I buy those up as much as I possibly can, and then I basically hold them until they reach intrinsic value or more. And if I've got somewhere else to put the money, I'll sell it and I'll put the money into that new thing. That's basically my strategy. It's the strategy of many a value investor in the world. So that's what I'm looking at doing. On terms of market timing, every single day I have seen people ask someone the question, should I buy stocks now or should I wait until they drop further and this sickness that is going on out there clears up and all those sorts of things. In my personal opinion, you should not be trying to speculate on what's happening with those factors. You should be trying to concentrate on individual businesses. As much as I may sound like a broken record here, concentrate on individual businesses, buy them when they're undervalued. That's basically all you have to do in investing. And the thing with stock markets is they are a predictor of future events. So the value of any business today should, in theory at least, be the sum of all the future cash flows that business will produce between now and when it eventually goes bankrupt, discounted at an appropriate rate to figure out what it's worth today as an investor. That is what any business is worth. It's future cash flows discounted to present value. And the way that the stock market works is it's always trying to predict what those future cash flows are going to be, and it's discounting at whatever interest rate people deem appropriate for that business. So when we have a whole bucket load of people trying to forecast future events for individual businesses, often what we'll find is when we are at peak pessimism and the sickness that's going on out there at the moment is as bad as it can possibly be. Stock prices are probably not going to get much lower than that because the only way that things can really go after that point is back up. We often see that, in this situation, we've seen stock prices decline massively when we're still relatively early in this whole thing, and that can happen going the other direction as well. So stock prices can shoot back up quite dramatically before this whole situation is resolved, before we're even out of the depths of what's going on. So in terms of trying to time markets, it's a loser's game. It's very, very hard to do. I think you should buy businesses when they're trading at prices that seem attractive, and not really worry about the rest. If prices go down after you buy, that's good news for the long-term investor and someone that's going to acquire shares, acquire assets over a long period of time. If prices go up after you buy, you may not have got an opportunity to fully, back up the truck on that position, as it were, but you can't complain about making money. So those are my thoughts. I don't think you should be selling everything and saying, I'm just going to wait till it goes down, and then when it starts going back up again, I'll buy back in. These things can change so quickly, and we saw even just on Friday that The US market was up like 10% in a day. I'm not of the opinion that it's going to stay there, but what I'm trying to say is that these things move very, very quickly, far more quickly than you can probably get your money back on the table. So those are my thoughts on market timing, and those are kind of two of the common things that I see going on out there at the moment. Is people think something's at a 20% discount just because it traded at a higher price in the past. That is completely irrelevant. Look at what the business is going to do in the future and make an assessment of what kind of return you want to make. And don't go out there trying to time markets. Every bit of research ever shows it doesn't work. So those are my thoughts. That is what I'm currently doing in the stock market. I hope you enjoyed the video. As I say, keen to hear your questions and what you're kind of doing at the moment as well. So drop them in a comment down below. But that's all from me today. So I hope you have a great day, and I will see you in the next one. Cheers.